He's getting antibiotics treatment, but he and I have been in touch, and he says he is feeling much better and looking forward to being back soon. And he's been courteous about encouraging the hearing to proceed, given that some of you have come some distance. And his opening statement will be read into the record by Senator Johnson, who was sitting for him. So let me open with mine and then turn to Senator Johnson. Last year, the Budget Committee held several hearings addressing how tax cuts for large multinational corporations and ultra-wealthy individuals have worsened income and wealth inequality in this country and hurt small businesses and blown a massive hole in the federal budget, creating enormous budget deficits. We have proposals on our side of the dais to raise revenue from the ultra-wealthy and large corporations. These proposals would place us on a sounder fiscal footing and make our tax code fairer. I've invited my Republican colleagues to put forward their own tax fairness and revenue proposals, an invitation I renew today. Today's hearing is about how giant multinational corporations avoid taxes by stashing profits in international tax havens, and how the Trump tax law made this offshoring worse. One example, a few years after the Trump tax scam took effect, U.S. multinational corporations reported nearly $40 billion worth of profits in Bermuda, which is about 6 times Bermuda's entire actual economy. The victims of this obvious tax scam are American workers who lose jobs to overseas competition, small businesses who pay their taxes and have to compete with big businesses that don't, and kids and grandkids who get saddled with additional federal debt. In the words of Dr. Clausing, who is here with us today, the Trump law's offshoring provisions are America Last tax policy. How is this even legal? Well, for decades, loopholes in U.S. tax law have let companies use accounting tricks to move profits earned here in the United States to offshore tax havens. The Trump tax scam supercharged the offshoring incentive, claiming to set guardrails that many pointed out were doomed from the start. Spoiler alert, the guardrails didn't work. No surprise, with the offshore tax breaks baked into the law, that U.S. multinationals reported nearly 60% of their foreign profits in 2020 in 15 tax havens, dwarfing what they reported in countries where they did real business. It's fakery, and it gets worse. The new Trump tax law didn't just help companies stash profits in sham shell companies, it created new incentives for offshoring real jobs and real investment. These offshoring provisions created jobs, all right, just not in America. Here's how the scam works. If a multinational funnels its profits offshore, it gets a half-off discount on its taxes in the shell entity. Then come further exemptions. Build a factory overseas and pay 0% on a portion of foreign profits. The more factories overseas, the more avoided tax. And because our friends always take care of big oil companies get a special added 0% carve-out. The best dodge is a combo of factories in foreign countries and sham subsidiaries in tax havens like the Cayman Islands or Bermuda. This is happening right now. Senator Wyden investigated Big Pharma's tax dodging and showed how tax gimmicks let big corporations get away with paying almost nothing in taxes. One example, pharma giant AbbVie is an American company that makes 72% of its sales to Americans. But with a subsidiary in Bermuda and manufacturing facilities in Puerto Rico, Singapore, and the Netherlands, it reported 100% of its profits offshore in 2019. Evidently, it made no money in America. After the Trump tax scam passed, AbbVie's CEO bragged to investors that it would cut their tax rate in half. Sure enough, Senator Wyden's investigation found that AbbVie had a tax rate of just 8.6% in 2019, well below what small businesses, real American businesses, or teachers and firefighters contribute in taxes. When multinationals make the great tax escape, everyone else must pay the price. Offshore tax breaks hurt American workers by sending jobs overseas. Sure enough, since the Trump tax scam passed, multinational corporations have increased foreign investment more than domestic investment. The tax scam hurt small businesses, who pay their taxes but must compete with big multinationals using sophisticated tax schemes to game the system. Even large domestic companies can be hurt. I ask to put into the record a statement from Rhode Island headquartered CVS, a purely American company that has to watch big international companies use offshore tax scams to pay less tax. These offshore loopholes add hundreds of billions of dollars to the deficit every year. If you're looking for a way to reduce federal debt and bring jobs and investment back to America, removing a tax scam that rewards offshoring is an obvious solution. We can do that. My No Tax Breaks for Outsourcing Act would shut down the scam. It's simple. U.S. multinationals would pay the same tax rate on foreign profits as real American businesses pay. The Biden administration and Senators Wyden, Warner, and Brown, and Senator Sanders all have related proposals. Each plan would implement the global minimum tax agreement negotiated by Secretary Yellen to end the international race to the bottom in corporate tax rates. Will boost the competitiveness of American domestic businesses of all sizes and boost America's competitiveness as a place for jobs and investment. It even boosts the competitiveness of U.S. headquartered multinationals because foreign competitors will pay a minimum tax on foreign profits. America can't compete with a 0% tax rate in some offshore tax haven, and we shouldn't let that scam persist. Corporations should contribute a fair share to American infrastructure, national defense, and education, investments that help make America the best place in the world to do business. When we stop the offshoring tax scam, America and Americans will win. With that, I turn to Senator Johnson to read the opening statement of Ranking Member Grassley.
Thank you, Mr. Chairman. And if Senator Grassley is watching, I think we both wish him a full and speedy recovery. I'm happy to read his opening statement. Mr. Chairman, thank you for calling today's hearing on our international tax system. The subject of this hearing is a blast from the past. The issue of corporations shifting profits and operations offshore was a problem Senator Baucus and Senator Grassley explored regularly as either chair or ranking member of finance for much of the 2000s. The most egregious abuses included companies switching their headquarters offshore in name only for the primary purpose of avoiding U.S. tax. To stem the tide of these so-called corporate inversions, Senator Baucus and Grassley spearheaded anti-inversion legislation enacted in 2004. However, they understood that ending inversions and other abuses for good would require reforming our uncompetitive corporate tax code. Over the following 12 years, a bipartisan consensus emerged that our high corporate tax rate, coupled with an outdated worldwide system of taxation, needed to go. But legislative action remained elusive. Our corporate tax system was being strained to its breaking point. We faced a resurgence of corporate inversions, tax-motivated foreign takeovers, and a shrinking corporate tax base. Then in 2017, Republicans enacted the Tax Cuts and Jobs Act to modernize our international tax system and bring our corporate tax rate in line with other developed nations. This included enacting strong anti-base erosion and profit-shifting rules. These reforms reversed a decades-long trend of a shrinking corporate tax base, driven in part by corporate profit shifting and base erosion practices. As shown by this chart, CBO now projects our corporate tax base to be on the verge of becoming larger than at any time in the last 20 years. As explained by a 2023 paper published in the Contemporary Accounting Research Journal, under our previous tax code, foreign income was heavily tax-favored. This research confirms our reforms largely eliminate this tax bias. Moreover, the adoption of a lower corporate tax rate and other pro-growth reforms made the U.S. a more attractive place for both domestic and foreign investment. Some Democrats have tried to demonize these reforms, particularly the lowering of the corporate tax rate from 35% to 21% as a supposed radical right-wing corporate tax giveaway. But what they don't tell you is these reforms merely move the U.S. from being a high-tax outlier amongst our major trading partners to the middle of the pack. The truth is, TCJA was a thoughtful and measured response to problems that plagued our corporate tax system for decades, and it worked. Upon its passage, companies called off inversion plans, and there have been no reports of major inversion transactions since. According to a study recently released by the National Bureau of Economic Research, TCJA significantly boosted domestic investment, contributing to higher wages and economic growth. Jason Furman, who was President Obama's chair of economic advisors, responded to the robust evidence in this paper, exclaiming, quote, "Taxes actually do matter," unquote, along with a series of online posts praising the study. I support continuing to explore options to further improve our international tax system. But proposals included in President Biden's proposed budgets to Congress would take America's tax code backwards. President Biden wants to take us back to having the highest corporate tax rate amongst our major trading partners, and back to an international tax system that put U.S. companies at a disadvantage in overseas markets, while also surrendering our sovereignty and tax base to foreign nations. This means lower wages and lost jobs. This Senator Grassley cannot support. That ends his statement. I'll just say that from my standpoint, I would never defend the U.S. corporate tax system. I mean, it's a mess. It's complicated. And what I would like to see is this committee, the Finance Committee, work toward tax simplification and tax rationalization. We're going to be talking about all kinds of very complex tax issues at this hearing today. And if we just focus our attention on what we can do to eliminating the complexity and focus on simplifying and rationalizing a tax system, I think an awful lot of these problems would take care of themselves. But with that, thank you, and I look forward to hearing from all the witnesses.
I think on that point, Senator Johnson, we may have some common cause.
There you go.
And let me introduce the witnesses. Our first is Dr. Kim Clausing, who is the Eric M. Zolt Chair in Tax Law and Policy at the University of California, Los Angeles. She previously served in the Biden administration as the Deputy Assistant Secretary for Tax Analysis at the Treasury Department. Next is Roy Hausman, the Legislative Director for the United Steelworkers and Vice President of the Union Label and Service Trade Department at AFL-CIO. Prior to joining the United Steelworkers in 2011, Hausman served as a City Council member for Ward 2 in the city of Missoula, Montana. Presumably he's had to put up with John Tester. Third, we have John Arensmeyer, the founder and CEO of Small Business Majority, the leading advocate for America's small businesses. Prior to launching Small Business Majority 18 years ago, Mr. Arensmeyer was the founder and CEO of ACI Interactive, an award-winning international interactive communications company. Next will be Dr. James R. Hines, Jr., the Richard A. Musgrave Professor of Economics in the Department of Economics and the L. Hart Wright Collegiate Professor of Law in the Law School at the University of Michigan. He's the Research Director of the Office of Tax Policy Research in the Stephen M. Ross School of Business. And finally, Mindy Hertzfeld is joining us. She's Professor of Tax Practice at the University of Florida Levin College of Law. Since 2014, she's been contributing editor to Tax Notes International. She's written hundreds of articles on international tax policy, as well as other tax policy matters. I welcome you all, and Dr. Clausing, if you could proceed, we'll try to keep you to 5 minutes each. Your full statements will be made a matter of the record.
Thank you, Chairman Whitehouse and members of the committee, for inviting me today to share my views on international tax reform. Today I will make 4 key points. First, international tax is a policy area that deeply benefits from international cooperation. Because capital is very mobile across borders, over the past 40 years, governments have steadily lowered their corporate tax rates, operating out of fear that they will otherwise lose jobs, investment, and tax base to countries with rock-bottom tax rates. Governments have been particularly generous to the largest, most dominant multinational companies who often benefit from special regimes and rates. Fortunately, by working together with other countries, we can counter those trends. The recent international tax agreement, now being implemented throughout the world, will levy minimum levels of corporate tax. About 90% of multinational companies are already on track to be covered by the agreement. The agreement reduces the pressures of tax competition, and it helps any government that wants to protect their corporate tax base and have a fair and efficient tax system. Here in the United States, global minimum tax adoption gives us more policy space to raise revenue from the corporate tax. The OECD recently did a comparison of countries in terms of their corporate tax revenues relative to the size of their economy. Of 115 countries, we're ranked 105th in terms of corporate revenue, despite having more profitable corporations on the Forbes Global 2000 list than any other country. There is certainly room to raise more revenue from U.S. corporations, and this agreement will help us do that. My second point is that the Tax Cuts and Jobs Act laid some really important groundwork for future reform, but it has a disappointing record in terms of both offshoring and profit shifting, which continue to be a very large problem. The guilty provision of the Tax Cuts and Jobs Act favors every type of foreign income relative to U.S. income, whether in high tax or low tax countries, which directly encourages the offshoring of economic activity and profit. My third point is that the Tax Cuts and Jobs Act made a large contribution to our high levels of deficits and debt that we see today, while making the tax system less progressive and less efficient. Deficits are now forecast to run about 6% of GDP over the coming decade, and debt levels will rise to nearly 120% of GDP. And of note, these forecasts do not incorporate the nearly $4 trillion price tag of extending Tax Cuts and Jobs Act provisions that are either scheduled to expire at the end of next year or the business tax provisions that are already causing tax increases that were built into the Tax Cuts and Jobs Act. As a whole, those extensions are simply unaffordable, and beyond that, we need to reduce the primary budget deficit. Raising revenue is important, but it need not entail particularly high rates. Even returning the corporate rate to 28%, which is halfway between current law and pre-Tax Cuts and Jobs Act law, together with international reforms that would counter profit shifting and offshoring, would raise about $1.5 trillion. We don't need high rates if we can get serious about reducing the gaming that occurs when there are large rate differentials between types of income, and in this case, foreign and domestic. The corporate tax rate also has a very important role to play in building a fair and efficient tax system. The corporate tax is a progressive tax, so increasing it will fall more heavily on shareholders than on ordinary workers. Further, the tax system is often our only shot at taxing capital income, since most capital income goes untaxed at the individual level or benefits from deferral. Taxing multinational income also serves the efficiency of our capitalism. Since Adam Smith, we've known that market economies work best when competition is vibrant, but over the past few decades, the U.S. economy has become less and less competitive. By taxing the largest multinational companies at some minimum rate, we can make it easier for small businesses to grow and compete, and we can create a more level playing field at home for our domestic competition. Finally, international tax reforms are at the ready that would help us respond to these challenges. Senator Whitehouse's sponsored legislation is one promising way forward. The Biden administration and the tax writing committees have also suggested important international tax reforms that would meet the moment. Today, such reforms are good not only for revenue and fairness and efficiency, but they are also consistent with U.S. leadership in the world economy, helping us work together with our partners abroad to address global collective action problems like profit shifting and like offshoring and like tax competition. This cooperation also builds the trust that is needed to tackle other global collective action problems that are very pressing today, including those surrounding climate change and national security. Thank you so much, and I look forward to taking your questions.
Thank you very much. Mr. Hausman.
Okay. Good morning, Chairman Whitehouse. My regards to Ranking Member Grassley and Member Johnson and members of the committee. My name is Roy Hausman. I am the Legislative Director for the United Steelworkers, or USW. I have the honor to provide this testimony for not only the USW, but on behalf of the American Federation of Labor and Congress of Industrial Organizations, or the AFL-CIO, representing 60 member unions and their nearly 13 million members. As the largest manufacturing union in North America, the USW represents about 850,000 active and retired members in a wide range of industries, from healthcare nurses to manufacturers of paper, tires, and yes, steel manufacturing. The success of union members and really every U.S.-based private sector employer is very much dependent on the tax and trade policies elected leaders like yourselves vote for and implement for our great nation. That is why the AFL-CIO and the steelworkers strongly support no tax breaks for outsourcing, sponsored by Chairman Whitehouse, and in the House of Representatives by Lloyd Doggett. The legislation reprioritizes the U.S. tax code towards American manufacturing and corrects policies which currently encourage American-based companies to shift manufacturing plants overseas. As countries across the globe compete to expand their own manufacturing prowess, our elected leaders need to rethink tax policy choices voted on by previous Congresses and enacted by previous administrations. I am certain that the Tax Cut and Jobs Act of 2017, also known as the Trump tax law, remains divisive in the United States Senate. The AFL-CIO and the USW remain strongly opposed to the legislation for reasons such as more than half of the benefit of the law went to the top 5% of taxpayers in 2020. However, for the purpose of this hearing, the union implores both sides of the aisle to rethink tax incentives which provide benefits to multinational corporations to outsource to foes and friends alike. My written testimony highlights problems with complex tax terms that others on this panel have significant day-to-day experience on. But in the simplest terms, tax bill drafters created a system where the profits of U.S. multinationals' overseas firms are effectively subject to a minimum tax rate of 10.5% versus the U.S. corporate rate of 21%. My sincere hope is that every senator here understands the significant incentives multinationals have over domestic companies by paying half the corporate rate on their overseas profits. It is important to note that foreign governments already offer significant subsidies to companies to locate overseas. The USW has fought illegal subsidies by China and a host of other countries through our nation's anti-dumping and countervailing duty laws with reasonable success. One database currently highlights that there are a total of 5,977 subsidy policy changes and awards implemented by other nations. For the regular union member, it is frustrating that the U.S. tax code heaps a tax subsidy on top of a raft of foreign subsidies to encourage outsourcing. Having been a shop floor paper worker myself, I'm confident the vast majority of USW members file their 1040 tax form, grumble a bit about their taxes, and eagerly await any refund entitled. However, you ask them if it makes any sense that American corporations, as a group, reported to the IRS that they earned $60 billion in the Cayman Islands in 2019, when the entire economic output of that tiny nation was just $6 billion that year. I am confident they would call this a tax loophole. It is time to end this double-speak math and start treating tax havens for what they are. The practice, as mentioned in my testimony, costs the United States tens of billions every year. Similar legislation to the No Tax Breaks for Outsourcing Act received a joint committee on taxation score. That bill closed off nearly $1 trillion in tax loopholes over a 10-year budget window. To give perspective, Congress and President Biden fashioned a bipartisan investment in our domestic semiconductor industry, commonly known as CHIPS, with the potential to create hundreds of thousands of jobs and maintain our global competitive edge in semiconductors for around $79 billion. Congress could fund 12 CHIPS-style bills with the revenue they currently give away to multinationals in the tax code. It is with extreme confidence that I could go to nearly any USW member in your states, explain the basics of no tax breaks for outsourcing, and they would see this as sensible policy to bolster our democracy, get unproductive money out of tax shelters, and put it to work in the U.S. economy. Thank you, and I look forward to any questions you may have.
Thank you very much. Mr. Arensmeyer.
Chairman Whitehouse, Senator Johnson, and members of the committee, I'm the founder and CEO of Small Business Majority, a national small business organization that empowers America's diverse entrepreneurs to build a thriving and equitable economy. We engage our network of more than 85,000 small businesses and 1,500 business and community partners to advocate for public policy solutions and deliver resources to our nation's primary job creators, primarily those in under-resourced communities. Our work is bolstered by research and the voices of real small business owners. Prior to launching Small Business Majority nearly 20 years ago, I was the founder and CEO of an award-winning interactive communications company, which I ran for 12 years. So on behalf of our nation's 33 million small businesses and as a longtime entrepreneur, I look forward to speaking about the critical importance of a system of taxation that promotes inclusive entrepreneurship as the foundation of our economy, one where individuals and corporations pay their fair share. In 2021, we conducted multiple surveys finding that America's small businesses strongly believe our nation's tax system favors large corporations and the wealthy over Main Street. Specifically, small businesses feel disadvantaged by loopholes that allow larger and wealthier businesses to avoid paying their fair share of taxes. Almost 3/4 agreed that the current tax system favors big business over small business. Nearly 70% cited that offshore tax loopholes allowed bigger businesses to avoid paying their fair share. And 2/3 said they support setting a minimum tax rate of 21% on corporate offshore profits. While large corporations continue to outsource production, investments, and output, resulting in them paying fewer taxes, our nation's smallest businesses, those that policymakers claim to be the backbone of our economy, simply do not have the same luxury. Like small business enterprises across the country, 75% of small businesses in our network have fewer than 10 employees. They do not have the in-house capacity, tax expertise, or legal counsel to help them manipulate complex tax loopholes to their advantage, thus creating a competitive disadvantage versus big corporations. While we're here to discuss offshore and international tax loopholes, they should not be viewed in a vacuum. The 2017 Tax Cuts and Jobs Act, so-called Trump tax law, that claimed to bring benefits to America's smallest businesses has failed on that score. Take the pass-through deduction as an example. While it is true that 95% of small businesses pass their profits and losses to their owners, a fact that is repeated ad nauseum by those advocating for tax cuts for the wealthy, the statistics on its own is meaningless. Based on the 2022 tax policy data, only 4.5% of businesses have pass-through income taxed at the top two rates, and almost 70% of all pass-through income is earned by those few businesses in those two rarefied brackets, not your typical Main Street small businesses. I should add that the average pass-through revenue for a small business is $33,000. The average pass-through revenue for those in the top two brackets is over $500,000. As such, we support legislative efforts to clamp down on loopholes for the wealthiest corporations in America, including the No Tax Breaks for Outsourcing Act proposed by Chairman Whitehouse. The 2017 tax law created new incentives to outsource production and jobs by cutting the tax rate in half for overseas investments, leaving made-in-America-based businesses, large and small, to pick up the slack. Requiring multinationals to pay the same rate on profits earned abroad would rectify this inequity. The money that large corporations are writing off in tax deductions overseas would be better spent here at home to reduce our deficit and fund critical programs that entrepreneurs rely on, including increased SBA lending capacity, the SBA's entrepreneurial development programs, such as the Women's Business Centers and Small Business Development Centers, expansion of the CDFI fund, removing the risk of further reductions in the state Small Business Credit Initiative, and full funding for the Minority Business Development Agency. I'll finish with a quote from Small Business Majority National Council member Clifton Bromond, owner of Man and Machine, a medical keyboard and mouse manufacturer in Landover, Maryland, that exports its products. Large businesses get to hide their taxes via overseas shell corporations. I pay taxes in foreign locations and in the United States on my business's profits. But if you have a lot of money to throw at a lot of lawyers, you're going to find a way to avoid paying those taxes. Clifton has not seen a penny from the promises of the 2017 tax law. Indeed, he stated that ironically, if he as a small business owner wanted to reap any benefits from the tax law, he would simply buy stock in a multinational company. Thank you for your time. I look forward to taking your questions.
Thanks so much. Dr. Hines, over to you.
Chairman Whitehouse, Ranking Member Grassley, and other distinguished members of this committee, thank you for the opportunity to participate in these hearings. These hearings concern incentives created by the tax system for firms to offshore jobs and profits. In thinking about jobs, it is important to bear in mind that in an advanced competitive economy like ours, people work for companies and are paid according to their productivities. It's not a secret. As the U.S. economy becomes more productive, as U.S. companies become more productive, U.S. workers are better paid. Consequently, the way to protect jobs, the way to create good jobs, is to have a highly productive economy. The tax system plays a role in that, since efficient tax incentives promote economic performance and inefficient tax incentives impair it. In the international arena, it is inefficient to subject the foreign operations of U.S. companies to significant U.S. taxes. The reason why is that U.S. taxes do not bear on the foreign companies with which the U.S. firms compete and the foreign markets in which they operate. All the taxes do is to put U.S. companies at a competitive disadvantage. This impairs their productivity, which spills over to U.S. operations, thereby depressing job opportunities and wages in the United States. It can be tempting to think that foreign business activity by U.S. companies comes at the expense of U.S. workers. But actually, what hurts U.S. workers are policies and actions that reduce the productivity of the U.S. economy. Greater foreign opportunities usually enhance job creation and compensation in the United States. The evidence indicates that 10% greater foreign investment by U.S. multinational companies is associated with 2.6% greater U.S. investment by the same firms. And 10% greater foreign employee compensation is associated with 3.7% greater U.S. employee compensation. Foreign business opportunities generally make U.S. companies more productive, thereby increasing their demand for U.S. labor. This matters because more than 1/4 of U.S. private sector employment is in multinational companies. The 2017 U.S. tax legislation significantly changed incentives facing U.S. firms due to the reduction in the statutory corporate tax rate from 35% to 21%, the move to a territorial system, the introduction of GILTI, BEAT, FDII, and numerous other provisions. These changes made it possible for U.S. firms to operate on a more competitive basis relative to foreign firms. The 2017 legislation was directed at the problem identified by prior Congresses, the Obama administration, and the Trump administration, that U.S. taxation of foreign profits indirectly discouraged economic activity in the United States by making it more difficult for U.S. firms to compete in foreign markets. The 2017 legislation also significantly reduced incentives to report profits outside the United States. Of course, even with the lower statutory tax rate, GILTI, and the other new provisions, many U.S. taxpayers would save taxes if they could report profits in zero-tax foreign locations. People are worried about this problem, but it is important not to exaggerate its magnitude. Even when the U.S. tax rate was 35% and there was no GILTI, most large U.S. multinationals had no tax haven affiliates at all. These firms were certainly not shifting profits to tax havens, which tells us that doing so is costly, difficult, and usually infeasible. We need to enforce our tax laws, but should do so with a clear sense of what the problems are and what we are trying to accomplish. It is in the country's interest, and more specifically in the interest of U.S. workers, to have a competitive tax system that supports the economy while collecting the revenue that we need. This problem is difficult enough without exaggerating any of its components. Wise design of U.S. policy has the potential to position the country for robust economic growth, and U.S. economic fortunes depend on it.
Thank you very much. Ms. Hertzfeld, Dr. Hertzfeld. Ms. Hertzfeld,
No,
Dr. Hertzfeld? Okay.
No, doctor. Chairman Whitehouse, Ranking Member Grassley, and members of the committee, thank you for the opportunity to testify today. My testimony will focus on 3 points: the importance of protecting the U.S. tax base as it relates to cross-border income, the ways in which the Tax Cuts and Jobs Act strengthen that base, and the risk that the OECD agreement, the two-pillar project, poses to that base and to U.S. revenues. For a mix of both foreign and domestic policy reasons, Congress has, since the early days of the income tax, provided favorable tax treatment for foreign earnings, primarily does so by allowing a credit rather than a deduction for foreign taxes paid. And because both the U.S. tax and legal systems respect corporations as separate entities, and because the income of corporations generally isn't subject to tax to their shareholders until received as a dividend, foreign earnings have historically not been subject to U.S. tax until repatriated. Now, at various times over the past century, Congress has imposed limits on this treatment in response to profit-shifting concerns. In 1962, it enacted the Subpart F regime, which taxes certain income of foreign corporations currently to their U.S. shareholders. Congress has also enacted exit taxes, including an anti-inversion statute. Beginning in the 1990s, a number of trends combined to put pressure on the system. Due to globalization, foreign markets became more important for U.S. companies, and developments in logistics and transportation led to the growth of global supply chains. At the same time, other countries became more aggressive in using tax incentives to compete for foreign investment. Corporate tax rates worldwide decreased sharply, and tax preferences, such as patent boxes, enacted to lure IP investment and assets became popular. The pressure these trends put on the U.S. international tax system was manifested by a rising trend in inversions, U.S. companies reincorporating overseas, and in foreign acquisitions of U.S. companies, transfers of high-value IP offshore, and the increasing pile of offshore cash. TCJA addressed these concerns, incorporating many bipartisan proposals. Reducing the rate to 21% significantly reduced the incentives for shifting profits, assets, and entities overseas. Inversions have essentially stopped. Strengthened interest expense limitation minimized the benefits of inbound base erosion. Participation exemption addressed the lockout effect. The FDII deduction encouraged companies to repatriate their IP to the U.S., and the GILTI tax reduced incentives for outbound profit shifting. But the TCJA was mostly about strengthening secondary U.S. taxing rights. And soon after enactment of TCJA, the OECD kicked off the second phase of its base erosion and profit shifting project, the results of which grant other countries primary taxing rights over profits, which the U.S. has historically asserting taxing rights over. With the active participation of U.S. Treasury, the project has to date had two outcomes. Pillar 1, which is primarily focused on U.S. tech companies, represents a reallocation of historical taxing rights from the U.S. to market economies. And under Pillar 2, the Global Minimum Tax Agreement, the U.S. has encouraged other countries to adopt minimum taxes of 15%. The U.S., in doing so, essentially subsidizes these taxes through the foreign tax credit. The Joint Committee on Taxes estimated that the global minimum tax could cost the U.S. hundreds of billions in revenue, while the OECD has estimated that the primary beneficiaries of this tax are investment hubs, low-tax jurisdictions. No estimates for the cost to the U.S. of Pillar 1 have been released. The OECD agreement also opened the door for other countries to impose taxes on the U.S. domestic income tax base through the Undertax Profits Rule, or UTPR. Under this provision, U.S. business credits effectively become subsidies for other countries' revenue collection. But one of the most concerning aspects of Pillar 2 is the extent to which the OECD has stepped into the shoes of Congress and Treasury in writing rules that directly impact U.S. taxpayers without any of the oversight provided by the legislative process or as required by the Administrative Procedure Act. Congress can consider addressing process concerns relating to the OECD project by mandating greater oversight over international tax rulemaking. And it could address underlying problems with the U.S. tax rules exposed by the project by better defining the U.S. base to ensure primary taxing rights over profits from U.S.-created intangibles. Thank you again for inviting me to testify. I'd be happy to answer any questions you may have.
Thanks, Ms. Hirschfeld. I appreciate it. Let me begin by channeling my friend and predecessor, Kent Conrad, who sat here as chair of the Budget Committee for many years and was chair when I first came to the Senate. And he used to feature a graphic with a picture of a building in the Cayman Islands called Ugland House, in which 18,000 corporations purported to do business. It's only 5 stories high, only a couple of windows wide. Clearly, as Kent would say, the business that was being done in Ugland House was monkey business rather than real business. And I hope that we can agree that allowing international tax shelters like that, where companies actually aren't doing any real business, isn't just bad policy, but it ought to be nauseating to us to allow that kind of mischief to take place. Let me talk a little bit about the global minimum tax rate, Dr. Clausing. And we've heard some testimony in the Finance Committee and in this committee over the years that there's advantage, and we don't want to be anti-competitive for companies seeking lower tax rates. The factor that claim always seems to leave out is the differentiation between a multinational corporation and an American corporation, and the relative advantage of the multinational either of locating factories and jobs overseas or of playing games with Ugland houses and fake overseas shell companies to give themselves competitive advantage against another American company. And I can imagine, for instance, a big multinational that has a subsidiary, and the subsidiary is perhaps a chain of stores that compete with locally owned stores, tire stores, who knows what. And because the multinational pays super low tax rates, they can help their subsidiaries compete more successfully against the locally owned small business. Is that a real concern, and how much impact do you think fixing this problem will have in supporting both, I guess I would call them real American businesses, both large and small?
Yes, thank you for that question. I think it illustrates that there's multiple types of competitiveness that we should keep an eye on. One type of competitiveness is the competitiveness of U.S. companies when they face foreign competitors abroad, right? And those competitors abroad may have zero tax rates, right? And our companies pay higher tax rates. So one great thing about the Pillar 2 agreement is it raises that tax rate abroad from 0 to 15. So that already helps with that type of competitiveness. But a second type of competitiveness, which I think is more pertinent to your question, is the competitiveness of the U.S. location. And if we think about our interests as a country, it's in having our location be a competitive place to do activities, right? So if our firms, when they operate here in the United States, in states like Rhode Island or Wisconsin, if they're paying 21% on their U.S. operations, but they're getting a 50% discount to be abroad, that tilts the playing field in favor of operations abroad instead of in the United States. And it also tilts the playing field between different types of actors in our competition, as you point out, Senator Whitehouse. The small firms that don't have the advantage of having these subsidiaries offshore have to pay the full statutory rate, whereas big firms can get their global rate down to half that rate by managing to earn most of their profit offshore, as we saw in the AbbVie example that you mentioned in your opening statement.
Which may or may not be really earned
Yes.
offshore.
Indeed.
And I'd ask you, for the record, if you wouldn't mind giving us a couple of sort of juicy examples of where enormous profits are declared overseas without apparently any collateral work being done there, and that it's purely an accounting scam, if you would. Mr. Arensmeyer, you've been, active in trying to fight for small businesses against this kind of anti-competitive advantage for big multinationals against American small businesses. Would you care to add anything to what Dr. Clausing has said?
Well, Chairman Whitehouse, small businesses are looking for nothing more than a level playing field. And clearly you have a situation where they cannot compete tax-wise with entities that are able to get a more favorable tax rate based on a portion of their business being offshore. It's as simple as that. And small businesses have no only 1% of small businesses even export. So we're talking about businesses who are purely domestic, and they don't have, if there was any opportunity to take advantage of anything, they don't have the lawyers, the accountants to help them do it. So that's all small businesses want, is level playing field with their competitors.
Senator Johnson.
Thank you, Mr. Chairman. First of all, Mr. Arensmeyer, I completely agree with you. Whether you realize it or not, I wasn't a big fan of the tax reform, particularly in its initial state, because we were making a huge disparity between C Corps and pass-throughs. So I'm the guy that held out to make sure that we got some measure of relief for pass-throughs. It's not the way I would have done it. I guess what I want to talk about, I think, first of all, I want to thank the chairman for holding this hearing, and I want to point out, I think there's potential for a lot more agreement on this issue than there is disagreement. Part of my frustration here in Congress is no matter what issue you're talking about, whether it's health care reform, PBM reform, tax reforms, I'm always looking at whatever piece of legislation is being proposed as just another Band-Aid on top of a dying patient. I mean, our tax system is a mess. And so I guess what I want, the chairman, colleagues, the witnesses, I'd like people to think outside the box. And I hate the term tax reform. One of my favorite sayings is all change is not progress, all movement is not forward. Just because you're reforming something doesn't say you're making it better. In the end, I voted for the tax bill because it was better than what we had, and it did stop inversions. It did attract, profit back onshore, but it's far from perfect. So I would like to go back to a clean sheet of paper, and how do you design a simple and rational system? And I'll just throw on the table, start with the concept that income is income. I mean, it is just bizarre that we take a look at a different entity, oh, we're going to tax you at that rate versus an individual tax at that rate. In terms of capital gains, rather than just pick a rate out of the air, why not index to inflation to really account for and then tax it at a normal rate? So, I actually did during 2017, the lead up to it, I had my own tax proposal. I called it a true Warren Buffett tax. And the basic concept is you just turn all businesses into pass-through entities. You tax income at the shareholder level. You tax it once at progressive rates. I mean, I'd like to see a flat tax rate, but I think that ship has sailed. I'm not utterly opposed to progressive tax rates, so some measure of fairness, as long as it doesn't exceed a certain threshold. Most Americans don't believe that the federal government should ever take more than 30% of anybody's income. So I guess I would just like to ask all of the witnesses, if you were looking at a simple and rational tax system, what would be the first thing you would look at? What would be the first thing you'd eliminate? Again, I would eliminate C Corps and I'd turn them into pass-through entities and tax all business income at the shareholder level. And I'll start with you, Dr. Klausing.
I agree that I think we can have a much fairer, more equitable, and more efficient system if we focus on differentials between types of income rather than keeping the rate particularly high. On the individual side, that would mean more uniform rates between labor and capital. On the business side, I agree that we should avoid distortions in organizational form and tax all large businesses similarly. But we should also try to avoid big preferences for foreign income relative to domestic income. And by reducing those rate differentials, we can keep the overall rates high while still raising enough revenue to run the government.
Let me interrupt. When I said income is income, there wouldn't be differences. Everything would be taxed at the same rates. We'd figure out how to do that. Mr. Hausman.
Yeah, I mean, I think for our union, the concept and key piece for this discussion was really this idea that we provide incentives through the tax code to outsource. And I think this idea of adjusting revenue, making sure that, American-based companies like paper companies in Wisconsin, like Graphic Packaging Corporation of America, who are domestic firms, are not having to compete against global players at a rate that on the tax side, so that they're doing this weird competition. So I think for us, the union, we see, as you say, somewhat simplification, but ensuring that our international tax system actually generates the revenue similar to what we try and generate here from our American companies.
Again, understanding that competing overseas that adds a new complexity. I mean, if we just had, our country, that's all we had to worry about. I mean, now you have to have businesses compete overseas. Mr. Arensmeyer.
Well, absolutely, evening out the rate would do a lot. I mean, I don't know if you're proposing to actually have capital gains and ordinary income rates be more closely aligned. We would agree with that. I do think there's some practical issues of taxing shareholders who are shareholders of big multinational corporations.
It's eminently doable. We got computers now. We talk to the shareholder services. We do far more complex things than what you're contemplating, Senator.
I would be interested to hear the reaction of a number of people, the primary shareholders in these corporations to that. But in theory...
Well, let me just quick say, if the beauty of this scheme is if you're a low-income worker, the way you collect the taxes through a withholding. The corporations will pay the tax for the shareholders. So if you're a low income taxpayer, you'll get a refund then over that backup withholding. If you're Warren Buffett, you're going to put more pressure on corporations to pay dividends, which would help reallocate capital through the economy. So again, there's a lot of, but plus I would assess income based on cash based. So you can get rid of all these other, amortization, depreciation. It's cash income. A foreign tax paid is a deduction, not a tax credit. I mean, there's so many ways we can simplify this, and that's what I'm asking people to do. Dr. Hines.
Senator Johnson, I think you should look into options with a value-added tax. A value-added tax does a lot of the things you just described. It taxes income comprehensively, and it taxes it at a common rate. The one thing is it only taxes the income when people spend it. So you have to, you have to wait until then. But people do eventually spend their income. More than 150 countries have value-added taxes. They raise revenue, they do so efficiently, and it's an alternative that is really worth thinking.
They raise a lot of revenue because they put it on top of other things. Professor Hertzfeld.
Yeah, thank you. I want to focus on your question, or your point, income is income, and one of the large sources of complexity in our code and also arising from the global minimum tax is that we now have multiple definitions of income. So we've got our historical tax code definition of income, but we've got the corporate alternative minimum tax that has another, looks to financial statement income, and then we've got the global minimum tax that requires U.S. companies to now compute their income under that definition of financial statement income. And so having a single uniform definition of income would go a long way.
Okay. Thank you, Mr. Chairman.
Thank you, Senator Johnson. Our order at the moment is Senator Padilla, followed by Senator Braun, followed by Senator Merkley, followed by Senator Kane. Senator Padilla.
Thank you, Mr. Chair. Good morning, everybody. The impact of foreign tax loopholes extends far beyond just the record profits and inflated corporate bonuses that we read about all too often. It also has negative impacts on federal and state revenues, federal and state budgets, driving up deficits and limiting the opportunity for government to make investments in communities and provide support and programs that are so critical for so many families. Now, this dynamic, effectively, what we're doing, Mr. Chair, is subsidizing offshoring. Is far more expensive than initial sticker prices may lead us to believe. It risks good-paying jobs, as well as long-term reductions in GDP, the erosion of local tax bases, and increased spending on social services, which becomes necessary to protect displaced workers. So it's a compounded effect here. My question is for Dr. Clausing. How have foreign tax loopholes impacted state budgets? Let's focus on state impacts for a moment and how much state revenue is lost as a result of this offshore tax dodging.
Thank you so much for that question, Senator. It has an enormous effect on state budgets, in part because most state definitions of income piggyback on the federal definition. So when companies shift income offshore and earn it abroad instead of earning it at home, that reduces federal revenues, and it also reduces state revenues in tandem. There was a nice study by ITEP, which looked at what states could gain from just closing simple loopholes in how they treat foreign income, and they found a $17 billion benefit potentially from relatively simple reforms across states. And for California, you might be interested, that's about $3 billion of that 17.
So not insignificant by any means.
Yeah.
Now, I wanted to highlight for a moment a particularly egregious loophole within the global intangible low-taxed income, also referred as GILTI, structure, specifically exempting income derived from foreign oil and gas extraction. The Treasury Department estimates the carve-out amounts to about $84.8 billion as a subsidy over 10 years for multinational drilling companies. At a time when the science is clear that we have to act with urgency to prevent the worst of the climate crisis, it seems to me this carve-out is unacceptable and has outlived whatever usefulness it might have had. While the Inflation Reduction Act shifted several federal incentives towards clean energy and domestic sources, lingering carve-outs for foreign oil and gas are entirely counterintuitive to these efforts. So, Dr. Clausing, what policy changes should we consider as we work to reform the tax code in a climate-conscious and forward-looking way?
Yes, that's an excellent question. So I was at Treasury when we looked at those estimates on the the acronym is FOGE, but the extra benefit that you get from having foreign oil, energy, and gas income offshore. And as you point out, it's an enormous benefit, $80 billion for closing that loophole. So that is one change that should be made, absolutely. And I would point out that there's another $40 billion or so of subsidies within our tax code for fossil fuels, right? So if you could reverse those, that would generate a lot of revenue as well. And finally, I would just also point out that Senator Whitehouse has legislation, the Clean Competition Act, that was also well worth considering in this time of global competition and climate change, that would use our power as a market economy and our relatively clean production here in the United States to also encourage more global adoption of climate mitigation policies. So I think that that's another thing that we should be looking at in the time ahead.
Thank you very much. And just in closing, Mr. Chair, I don't need to tell you, for a lot of the climate deniers out there, for the cynics about renewable and other clean energy sources who complain, well, where would they be without subsidy? Fossil fuels have benefited from enormous subsidies over the years, especially the foreign sources. So thank you, Mr. Chair.
Testimony in this committee says that the fossil fuel annual subsidy in the U.S. every year is over $600 billion from the International Monetary Fund, so it's a pretty serious number. Senator Braun. This billion with a B, just to be clear. Senator Braun.
Thank you, Mr. Chairman. I've been in so many of these hearings, and my observation is that we have two constants that are part of this discussion. You go back for 50 years, we've never generated, other than a couple, 3 years in the Clinton administration, maybe a couple years, more than 17.5% of our GDP and federal revenues. I'm not going to ask each one of you, but would you agree with that statistic? Are you aware of it? Just a nod of your head would be fine. I think it is. I mean, it's black and white. The other thing that's a constant since the Bush years would be that we've been running chronic deficits. I think that's black and white too. Probably got started even back in the Reagan years when we did cut taxes and paid no attention to what we were going to do with spending. That makes perfect sense knowing how this place works. So, given that's a constant, and whenever you, I think, cut taxes, you're going to deplete Treasury revenues a little bit, years 1 and 2 following it. Your economic growth generally does a little better. That might be kind of that trade-off stubbornness of why revenues never get much beyond 17.5%. So regardless of what we do with offshore revenues, whatever we do here, it seems like we'd want to make this place work with the reality of what the economy is able to do. I'd like to start over with Dr. Clausing and then go across the board. And I want you to make a statement. Is it tax policy? That's a bigger issue now on our trillion-dollar deficits we generate every 6 months. When I got here, it was every year about 5 years ago. And is it tax policy or is it spending? And try to make sense with whatever your answer is, that it doesn't violate that big statistic that we only generate 17.5% of our GDP and federal revenues. Dr. Clausing.
I think one thing we saw in the late 1990s when we did move towards better and better budget situation and ended up once with a surplus, I had to change all my class notes and describe that, well, the U.S. government can run a surplus, is that both taxes and spending are clearly important here. At the time that we ran that surplus, we got taxes relative to GDP more in the neighborhood of 20%. I don't think the 17.5 is an invaluable rule. That number does move around quite a bit.
Is 25% where we're currently at? What do you think of it? And that's occurred through COVID, through the present administration. When you look at spending at its current levels, it's closer to 25% of GDP. I didn't cite that earlier, but that's probably out there. you could never raise revenues to reach that level. Would you agree with that?
I have a proposal that suggests we should aim to reduce primary deficits by about half the size that they are now. I do think we have a huge gap between spending and taxation, and that's a problem, and it's one that Congress...
And you'd have to do that on the back of spending, just from the logic that we've been throwing around here.
I think taxes have an important role to play.
About half of it, you said.
In increasing the deficit, and I think people need to be able to compromise and address both sides of that equation.
Okay. Mr. Hausman.
Yes. Yes, to your question. I think, for the AFL-CIO and steelworkers, we see this idea that tax policy definitely has a major factor in how we address and improve the reduced deficit.
Up to what level? I agree it may
I think that if you're looking at a fact that in the current situation with all our foreign affairs issues that are going on right now, the fact that we have 12 aircraft carriers that need to be out there patrolling our seas, ensuring that safe transit of goods across the global economy, that we have to ensure that there may be revenue necessary to raise to ensure that safety and security.
And I think everybody would say that's a generally a statement that you can categorically disagree with, but put it in the context of running $2 trillion deficits annually.
Well, I think if you raise revenue to help reduce that deficit level, you're going to improve that overall outcome.
So you're with Dr. Clausen there a little bit, maybe 50-50. Yeah. Okay.
Correct me if I'm wrong, but I think the tax revenue shrinkage since the passage of the Trump tax law, I've seen estimates anywhere from $1 to $2 trillion. I defer to the experts.
It's $150 billion a year, which would be a very small percentage of our current $2 trillion deficits. I acknowledge that. Other than the CBO, right before COVID, was showing that was almost neutralized. So take that into consideration too. But I'll grant you what is real. $150 billion per year, which is a small percentage of $2 trillion.
Well, I believe there's been estimates if the Trump tax law was continued for an additional 10 years, it could be as much as a $4 trillion gap. So my only point is that tax revenue has come down, and certainly not.
And that would kind of make sense if you're doubling the time frame, but it's still percentage-wise the small part of our current borrowing and spending. Well, I think I'm right there on the numbers, and I agree with you that if you double the time span, it would be closer to $3 billion to $3 trillion to $4 trillion.
I guess my answer to the question is that right now, given the sort of reduction in tax revenue versus, have we continued before, that is more of a tax issue right now than it is a spending issue.
Well, then I'd say you're saying 7.5% to 15% of the deficit, which you've just blamed on the Trump tax cuts. That's a much, much smaller figure than where the balance of that deficit's coming from. Dr. Hines.
Senator Braun, we've got 3 colleagues waiting in
Yes.
line. If
just you want to go real quickly,
Senator Braun, I completely agree with you that the deficit is a huge problem and we need to do something about it. Your question was, and obviously you can either cut spending or you can raise taxes or some combination. Your question was, is it possible to conceive of taxing, say, 25% of the national income? There are countries that do it, like France. And if you want to have the economy of France, you can have their policies. But that's what you get, is an economy like France's, which is much less affluent than ours.
Thank you. Ms. Hirschfeld.
Yeah, I think if you're addicted to spending, no amount of revenues will be able to make.
I'd say you hit it right on the head. Thank you.
Senator Merkley.
Thank you, Mr. Chairman. The Trump tax law slashed the corporate tax rate from 35% to 21%. But that didn't trickle down to ordinary people. Rather than raising wages, corporations rewarded CEOs. They did stock buybacks, increasing the wealth of wealthy stockholders. An analysis from the IMF found that the top S&P 500 companies directed just 20% of the value of that tax cut towards capital expenditures or research and development, and put 80%, 4 out of every $5, to buybacks and dividends. And yet the Washington Post reports just last Friday that Trump wants to continue that strategy of cutting the corporate rate even further. So, Mr. Hausman, how would such a cut actually help small business and their employees when we saw that really what the tax cuts were designed under Trump were about helping mega corporations and wealthy stockholders.
Yes. So, from the union's perspective, these smaller unionized companies that we work with day to day. They pay their taxes, they produce a good, and then they provide it out to a larger the economy. And when you have these sorts of tax incentives to build out in low tax havens, and you have a capability through hiring legal and tax advice, you just create this perverse incentive for for regular American workers who don't feel like there's a fair competition. And I think that that's ultimately what we try and address here with no tax breaks for outsourcing and other areas, is that these issues like GILTI and others, they need to be updated. We need to address we need to approach this from like a constant movement towards improving our revenue to spending ratio, and it needs to be done in a timely fashion, which is really like something that the union workers do every 3 years when they bargain a contract.
Well, I sure would like to see ordinary Americans benefit rather than more tax policy directed to make the wealthy wealthier. And I don't see how doing the same thing that provides 80% of the benefits to the wealthiest is going to serve ordinary Americans. I wanted, and you mentioned that GILTI provision, which is also a provision that really helps drive our production overseas, which means even less good employment here in America. So if you want corporations to make their products overseas, that would be a very good policy, but I prefer that we make our products here and employ Americans. Would you agree?
Absolutely. I mean, for a union that has spent 1 in 4 anti-dumping and countervailing duty orders, that is because United Steelworkers have been a supporter of it. We've had to fight back against dumped and subsidized goods that have negatively impacted jobs here in the United States for decades. And the idea that tax policy could incentivize further outsourcing is absolutely atrocious. We should be using that revenue to generate and build American factories, not factories somewhere else.
Dr. Klussing, let me turn to you. The U.S. collects less in corporate tax revenues as a share of GDP than virtually any other advanced economy. How does that disparity in corporate taxation under the Trump tax law contribute to increased wealth inequality here in the United States?
Yes, the corporate tax is a very progressive tax, and if you compare it to our other ways of raising revenue, like labor income taxes, the payroll tax, it's by far the most progressive major contributor to our tax system. So when they cut that corporate tax so dramatically in the Tax Cuts and Jobs Act, and if you look at the other provisions of the act, they were also regressive. It exacerbated the amount of income inequality in the United States. And that same NBER study that was referenced in the opening Grassley remarks finds that 80% of the benefit of those corporate tax cuts went to the top 10% of the population.
Yeah. Well, it seems to me that there is a profound sense of the system being rigged, which increases cynicism in America, because we know that a large corporation uses a tremendous amount of the infrastructure built with our tax dollars, of our criminal justice system, of our trade system, of our education system, of all the people that hire. So isn't there something fundamentally unfair to have these massively wealthy corporations use a massive amount of our infrastructure and pay almost nothing towards sustaining it and improving it?
Yes, and I would point out that it's also inefficient. If you look at the largest companies, most of what they're earning is above normal profits, and those profits can be taxed without distorting labor decisions or investment decisions because they're earning above it and beyond the normal amount that it takes to get their businesses to function. So I think moving the corporate tax base even more in the direction of a pure profits tax would be helpful, but it's an efficient way to raise revenue in addition to being a fair way to raise revenue.
Thank you.
Senator Kane.
Thank you, Mr. Chair. In 2017, the Republican theory was cut taxes on large corporations and cut taxes on the profits they make overseas, and hope those companies will put their increased profits into new investments. In 21 and 22, we took a different direction. We invested in the nation's infrastructure, we invested in manufacturing, in industries that are poised to promote good jobs in the future: clean energy, advanced manufacturing, semiconductors, and others. I'm a former mayor and governor, which means I still kind of think of myself as an economic developer, so I'm making pitches all the time to companies about why to come to Virginia. I'm on the phone at least once a week with some company trying to make a pitch. I was on the phone with a company yesterday who's really excited about some of the clean energy provisions in the Inflation Reduction Act and some of the other investments in the infrastructure bill. Talk about these two visions, that, cut taxes and count on companies making more to help grow the economy versus direct investment in infrastructure and manufacturing. It's going to be a great case study. It may take another 10 or 15 years for people to really write the case study, but if I could begin with you, Dr. Clausing, talk about these two visions for growing the economy and growing prosperity for everyday Americans.
Yes, I think when we saw the Tax Cuts and Jobs Act enacted, there was a big debate about whether it would pay for itself, which it didn't, whether it would spur a new renaissance in wage growth and investment, which it did not. There was a lot of evidence that it increased shareholder value in the run-up to the legislation. The stock market soared. It increased buybacks a lot, but there was very little discernible effect on aggregate investment in the United States, and I think that was partly because of the fact that a lot of this tax cut was directed at these excess profits. So when you cut someone's taxes on their excess profits and they have extra money, they're already undertaking all the investments that they thought were rational to take. And so when you look at the benefits from that legislation, study after study has found that it mostly enriched shareholders and it didn't really trickle down to the typical worker. I think the vision of more recent legislation, starting with the infrastructure bill, it was a bipartisan bill, but also the CHIPS Act, which was bipartisan, and the Inflation Reduction Act, these are more about, I would call them a more modern supply side economics, or Secretary Yellen calls it that, so I'm really borrowing that term from her, in the sense that it's focused on really investing in the fundamentals of the United States, focusing on the people, the infrastructure, building up the United States to have those fundamental strengths so that we can compete in the world economy. And to be a fundamentally strong economy, we need adequate tax revenue to pay for these kinds of investments, which I think Mr. Hausman pointed to as well. So I think those types of investments are very useful in making our businesses work well if they have the infrastructure and the human capital that they need.
And Mr. Hausman, from workers' standpoint, and I'm proud to be a senator from a state where the largest steelworkers union in the International is located at our shipyard in Newport News. Talk about these two strategies, cutting corporate taxes versus investing in infrastructure and manufacturing, and how they affect working people.
Yeah, I mean, I think, historical precedent when we did rural electrification, when we've now trying to do that with broadband expansion across the country, I mean, it gets people into the economy, gets them productive, gets them active, and it gives them the opportunity to participate in their democracy. And I think that that's ultimately one of the key pieces here when we talk about these direct investments towards communities in need. The idea, maybe I'm a little old school, where I think it's important that every child gets every meal, and that everyone doesn't have to fret about the bills. And when we do direct investment and encourage good quality jobs, unionized jobs, we create an incentive out there in the economy that is so much more powerful than a corporate tax cut for the wealthiest people.
Just one thing before I hand it back to you, Mr. Chair. I remember the evening we voted on the bill in 2017, we got handed the bill, and we're told we had to vote on it right away. Most of us hadn't seen it. It still had handwritten interlineations that were hard to decipher. And then we got a chance to make amendments where we could speak for 1 minute and then have a vote on an amendment. My corporations in Virginia, they liked the notion the corporate tax was going down, but they weren't asking for it at 21. They were saying, can you do it at 25 or 26? And so I proposed an amendment that night, recognizing that the corporate tax cuts in the proposal were permanent, but the individual tax cuts were temporary. I said, well, why don't you just take the corporate tax rate, if you're going to do it and you're going to drop it to 25 or 26, and then make the individual tax cuts permanent. And that got roundly voted down by my Republican colleagues, demonstrating that the preference was not to really assist the individuals in the tax code, but to assist corporations. I still don't know that it would have been that great a bill, but it would have been a lot better bill if we had rebalanced it more to focus on individuals rather than on corporations. Thanks, Mr. Chair. I yield back.
Thank you very much, Senator Kane. Senator Van Hollen.
Thank you, Mr. Chairman. I know my friend and colleague, Senator Kane, is a very effective economic recruiter, so long as he's not doing it from folks who are working in Maryland, companies in Maryland, that's fine. We have peace across the Potomac. But I want to make one point at the outset here in terms of the conversation about 17% of GDP being somehow an immutable cap on revenue. That's clearly not true. I think, Dr. Clausen, you pointed out that in the early around 2000, 2001, it was about 20%. And that also is the last time we actually did not run a deficit. Isn't that the case?
That's correct.
That's right. And then, of course, we had the Bush tax cuts, and that erased that advantage. So the notion that somehow we cannot add additional revenue to meet the needs is clearly inconsistent with our own history. Let me ask you, Dr. Clausen, about country-by-country reporting, because we're focused on tax havens, and one of the challenges in our efforts to develop responsible tax policies, lack of information about how corporations use offshore tax havens. The Financial Accounting Standards Board, FASB, has issued an international tax disclosure standard that would require additional disclosure of foreign taxes that companies pay. I've introduced legislation called the Disclosure of Tax Havens and Offshoring Act to require the SEC to mandate that large corporations disclose basic tax and financial information on a country-by-country basis. I think their investors have a right to know how exposed they are to tax havens and how exposed they are to changes in tax policy. Could you talk about the importance of country-by-country reporting, and do you think it would provide valuable information for investors, the public, and policymakers?
Yes, I think this kind of reporting is very important, and it need not be particularly complicated. We're not asking for the release of an entire return. It's just how many employees, how much income, how much tax are you paying in different countries throughout the world. And the reason that's such useful information is, while it's very simple information, it really forces companies to be transparent. If they're going to earn most of their income on an offshore location where they have almost no employment, then they should be willing to say that out loud to their investors, to their workers, to their consumers, and to the American public, because what they're doing is effectively putting those tax burdens on others. And I think shining sunshine on this is, in a way, a market-friendly nudge. It's just saying, tell us what you're doing. We're not going to regulate per se. We're just going to ask you to share your information with the public. And I think that sunshine might lead to useful changes in their behavior as well.
No, I appreciate that, and transparency usually works for the best of everybody, so people can't hide what they're doing from investors and the public and others. So there's a lot of talk about GILTI. I remember when the Trump tax bill was on the floor of the Senate, many of us, including myself, warned about the provisions that would encourage the offshoring of American investment and jobs. But we talk about it in these very general ways. Could you talk a little bit about what you've seen since the passage of that bill with respect to its impact and the fact that there's a greater incentive to invest in tangible assets overseas rather than here at home? Mr. Hausman spoke about that a little bit, but if you could just shine a little bit more of a light on how that mechanism works.
Yes, so there are 4 studies that are cited in my testimony that I would refer people to look at that sort of document this, but let's just talk about it pragmatically. So if you think about what a tangible investment is, it's something like plant or equipment. And when you have more tangible investments offshore, that generates more income that's free of U.S. tax. It's free of that GILTI, because the first 10% return on those tangible assets offshore is completely free of U.S. tax. And we don't have anything analogous in the United States. We don't give people the first 10% return, on their domestic assets in Maryland or Virginia. They don't have that. On the contrary, the FDII provision, which is this export subsidy, only gives that export subsidy for returns above a certain asset. So if you take a tangible asset out of Maryland and you put it in an offshore haven, it will both increase your export subsidy in Maryland, ironically, and it will increase the amount of tax-free income offshore. So those are sort of, to say the least, perverse incentives that we've got baked into the code. And those 4 studies that I cite in the testimony document that they're having real effects on the location of tangible assets.
I appreciate your walking us through that because it is complicated, but the bottom line is an incentive to ship U.S. jobs and investment overseas. Mr. Chairman, with your indulgence, I'd just like to ask every member of the panel a yes-no question. I've been doing this in a lot of these hearings. This discussion already came up, but because of the hype that was presented at the time of the Trump tax cuts, claiming that they would pay for themselves, I just ask everybody, especially our economists, whether in fact the Trump tax cuts pay for themselves. Let's just start with Dr. Clausen and just go down the line.
They did not.
Yeah.
Does not appear so.
They did not.
No, they did not.
It's not something I'm qualified to speak to.
Got it. Thank you. Thank you, Mr. Chairman.
Senator Van Hollen is pretty good at raising that question and getting clear answers to it, hearing after hearing, so well done. Let me wrap up the hearing with my appreciation to the witnesses, and I'll close where I began, which is with Ugland House, Kent Conrad's favorite piece of real estate, at least for rhetorical purposes, and the preposterous claim that 18,000 different companies are actually doing business out of that one small location in the Cayman Islands. That kind of mischief ought to have no place in our tax code. And I hope we can find bipartisan ways to get rid of that kind of nonsense. Not only is it nonsense, or as Kent Conrad used to say, the business that's being done at Ugland House is monkey business, but it's also unfair because it builds a bias in favoring big companies that have the resources to employ the tax accountants and the lawyers and all the people that are necessary to manage a fake entity in a foreign tax haven versus the florist or the dry cleaner or the small business that is a real small business, the kind that Mr. Arensmeyer here is representing and speaking for. So at a minimum, we ought to be able to get rid of that nonsense, and I hope we can also come to some form of bipartisan agreement that creating an incentive for an American company to build a factory and hire workers overseas instead of in the United States, not because of some attraction of that foreign country, but because we have baked into the tax code, the U.S. tax code, that perverse incentive. I hope we can find a way to get some bipartisan progress there as well.
Just quickly, Mr. Chairman. Senator Kaine, I had a great deal of sympathy for that amendment you offered, okay? You know I was digging my heels into saying we've got to have much fairer treatment for pass-throughs, smaller businesses versus the C Corp. The problem we have right now is both sides have, I would say, abused the reconciliation process. When the stars align, you have the House, you have the Senate, you have the presidency. We use this budget reconciliation process. You ram through, whether it's tax cuts or larger spending, at the last minute, nobody sees any of this stuff, whether it's the spending bill or the tax bill, okay? That dysfunction has to end, and what I would recommend, and why I appreciate this hearing so much, is we've got a major fiscal cliff occurring in 2026. Small businesses are going to be really put at a disadvantage when, again, I couldn't believe, what I held out for was only for 8 years. I would have been happy to increase the corporate tax rate to make that permanent so we wouldn't face this fiscal cliff. I guess what I'm suggesting is let's sit down now. I mean, the hearing's a good start. But let's sit down with our offices and let's start looking at these areas of agreement, because there's a lot of agreement here. There's a lot of agreement. Starting with that we've got a really complex and broken tax system. Let's simplify and rationalize it. So, again, I've talked to the chairman. You know about my true Warren Buffett tax. You talked about that in 2017. Let's start fleshing these things out. Let's be honest about the complexity of this stuff. Let's try and set the rhetoric and demagoguery aside, and let's really focus on the areas of agreement. I'd love to sit down with the chairman of the Finance Committee as well, now that I see he's attended here. Let's start working this out now so that when we get to 2025, we actually have a bipartisan package, something we can all agree on and pass in regular order, as opposed to abusing the reconciliation process.
Let me recognize and welcome the distinguished chairman of the Finance Committee and yield to him for his questioning.
Well, I thank the chairman, and I see also Senator Johnson and my colleagues here who've done very important work on these kinds of issues. I also want to recognize that in the House is my old neighbor, Kim Klossing from Southeast Portland. We got to lure her back, and we so appreciate her, being here. Look, what we're trying to do is use this year to the greatest extent possible for helping people and then to tee up 2025. For example, and Senator Whitehouse knows this in particular because, he is so knowledgeable about the budget, and as we try to, work through these issues, is that we are looking at a 3-year bill, so there will be an opportunity. For example, I very much like the small business provision, the expensing provision, which is getting no coverage, and every progressive small business group likes that. And we're going to be doing that for 3 years. And I very much like the fact that we are embarking on a pro-family policy, because right now, these families, and my understanding is about 70% of the eligible families have more than one child, but they really only get credit for one child for purposes of the reimbursement policy. So when Chairman Whitehouse and I talk about this stuff, you hit yourself in the head and say, how in the world does that make sense? So what we're trying to do is to help people now, but to do smart things that tee everything up for 2025. Ms. Klossing, you've been working in these tax precincts for a long time. What do you see as the key priorities for us going into the 2025 debate? And as you know, you don't have to go into a lot with billionaires for the chairman and I, because we've introduced the billionaire legislation. And Senator Johnson, by the way, has talked to me about this over the years. So if he wants to make a billionaire income tax bipartisan bill, I'm all in. But tell us what you think are the priorities for 2025.
Thank you, Senator Wyden, for that question and for your leadership in this area. 2025, as you know, is such an important year for tax policy. And as I mentioned earlier, the price tag for a carte blanche extension of the Tax Cuts and Jobs Act is $4 trillion if you include the business provisions that are already starting to bite. So I think my first priority for 2025 would be that we have to take serious deficit reduction and not just simply extend a series of prior tax cuts that aren't necessarily working well. A second point is that I think we need to make progressive changes in our tax system. I think the child tax credit improvements that you're suggesting in the legislation under consideration right now are a nice step in the right direction. I think we can afford to be even more generous with children and with the earned income tax credit while collecting more from those at the top who can really afford it. A third principle is efficiency. I think that we didn't get a lot of bang for the buck in the Tax Cuts and Jobs Act in terms of how much revenue we lost relative to how much investment and other useful things we encouraged. And there's some things like the R&D provisions that are actually discouraging benefits to greater society from research and development if we're having to amortize rather than expense that. And then finally, a fourth consideration that I think is really near and dear to my heart and to your work and to Senator Whitehouse's work is ensuring that the U.S. can work with partner countries abroad to address some of these global collective action problems. And both climate change and international tax competition are places where U.S. policy could better align with good policy and with what other countries are doing to solve those problems.
I'm almost out of my time, and I just want to have you, because you are so expert. You know, the billionaire policy now is really built on 3 words, really ending buy, borrow, and die, which is the 3-word formula that allows billionaires to go for years on end, years and years, paying little or nothing in taxes. I heard you say something about efficiency and revenue. Colleagues, the revenue estimate for eliminating effectively buy, borrow, and die is, by Joint Committee on Taxation, $550 billion over 10 years. Is there anything that raises more money from 900 billionaires? Colleagues, 900 billionaires, $550 billion, according to the Joint Committee on Taxation, by effectively ending buy, borrow, and die. Your thoughts on that?
Yeah, no, that is probably the most you're going to get from that population is through that legislation. You know, I think there are other things in the tax code that raise a lot of revenue, and the corporate increases that I was talking about earlier could bring in about $1.5 trillion if you cut the offshoring and profit shifting incentives and increase the corporate rate. But I think looking at ways in which people avoid defer taxation on their capital income is a really important complement to that.
Thank you, my colleagues, for all the extra time. Thank you for your good work, Mr. Chairman. Senator Johnson, look forward to working with you on this.
Yes, thank you, Chairman Wyden. Thank you to all the witnesses for your participation and your valuable help, and to Dr. Clausing for getting back to me with any particularly nauseating misuses of the foreign shell company scam. And as good as all the testimony was, I think the high point was Senator Johnson's confidence that we may be able to find some bipartisan action here. So on that happy note, let's put the hearing to rest. Thank you very much.